So I think firstly we're very pleased with the fact that we've had a pretty decent Q4 from a sequential growth perspective, right? We delivered 2+% growth, led by two of our biggest verticals, BFS and TMT. And I think we've called out for banking and tech to lead the recovery in the Q4 numbers. We were focused on recovery in the back half of FY24. It took a little bit longer, but I think we are very pleased with the way we've delivered that. There is early signs of at least some discretionary spend, shorter term deals, short burst, short duration projects. That's always very heartening to see. There are also some pickup in activity in pockets of banking that was quite muted last couple of years around capital markets. I wouldn't say that it's a roaring back to spend model yet, but definitely appetite is higher, and I think a little bit of that fatigue from overspending in 21 and 22 seems to have kind of gone away, and early signs of capital market opening up is definitely giving them comfort. Second, I think we're very pleased with the fact that what seemed to be a very big hype area around AI and Gen AI early part of calendar 23 is now actually converting into not just pipeline but also deals. So opening up a lot of new pockets of spend. How do you embrace tech to take cost out? How do you embrace tech to transform operations, customer experience, developer productivity, compliance monitoring, KYC? So lots and lots of real, credible, tangible deal constructs that are not just being talked about, but actually are in the pipeline and are in the wins. And I think that opens up a whole new addressable market for us. So we're very pleased with that as we go forward. The fact that these shorter term deals are showing some revival also gives us a little bit more confidence on revenue recovery, because a lot of these deals can be consumed within the year versus having a long duration deal where ramp up takes 6 to 9 months. We've seen better conversion of previously sold TCV to revenue as well this quarter, so that also helped the overall book of business for us. I think the TCV number is a little bit muted, driven partly by the fact that there is a bunching up of deals that happened early in the year. And secondly, this the 0 to 10 million deal category has actually been the highest TCV number for us in a few quarters in Q4. But on the flip side, that gives us confidence from a revenue growth standpoint as well. So I think overall pretty pleased with the way the team executed in a still tough macro environment, because uncertainty and creates inaction still underplay. Lots of countervailing forces between macro and inflation and interest rates and geopolitics. But the focus has really been on the micro and just driven by in-account actions, wallet share gains, and moving very aggressively into these new tech areas. Also pleased with the margin performance, and Manish can talk a little bit more about that.
Right. I'll talk about margins in a minute, but let's actually, why don't you talk to me about margins before we go into TCVs in a little more detail?
All of what Nitin said did require investments, and we were able to deliver expansion in margins, despite that. On a reported basis, the margins were 14.9%, but if you adjust for acquisitions, that's close to 16%, which is an expansion over the last year and over a few quarters that we were reporting. Especially happy with the fact that all of this came with the ability to kind of ensure that we continue investing in areas which will give us revenues in the future, which means investing in working with the clients, proof of concepts and stuff like that. Other than the margin, I think cash is king, as they say, and we had a very strong cash generation quarter, 116% of PAT. And when you think from a year-on-year perspective, that's 150 million growing to 237 million, more than 50% growth in the cash generation. So very happy with the cash and the EBIT performance. I think the silver lining, or rather, even bigger news, is the fact that EBITDA expanded to 18.7% from 18% last quarter.
Right, noted. So I guess no disappointments, at least internally. A couple of areas I want to talk to both of you about is TCV, and I'm sure both of you are expecting this to be my second question. While some of your peers have closed out at record values in TCV, with your company specifically, there's a decline in deal wins, not just as compared to your peers, but even if you compare it to your average historically. What is the reason for that? So I do understand that conversions, there is a delay, decision making is slow, values of deals, like you said, has also in the smaller band. But why is there a decline in the number of deals you're closing out?
I think I wouldn't say there's a decline in the number of deals. There's definitely a softness in the overall contract value reported. So I think the first thing to note is we are not including any renewals in our deal numbers as we report them. And that's been consistent for us for the last, as many years as we've reported it. So there is no lumpiness of year-end renewals or first quarter calendar year renewals for us. Second, I think we had a pretty big bunching up of deals earlier in the financial year. We had a record quarter of 700 million plus. As that pipeline got consumed, and the rest of the pipeline, obviously, we had to move that through the stages. Third, I think the duration of deals and 0 to 10 million, kind of having the highest contribution this quarter versus, I would say, the previous 4 quarters or 6 quarters, also is a sign of a little bit of recovery, as I mentioned. The metric to note, though, is the pipeline is actually still fairly healthy. It's up 5% sequentially, and it's up pretty broad-based. Even in our banking business, which was obviously a little bit stressed last 12 months, the pipeline is up almost 19% on a sequential basis, and our top 10 account pipeline is also up. So I think all the leading metrics are pretty decent. We will obviously continue to focus on large deals. We had 1 large deal in Q4, but 15 large deals for the year. That definitely gives us runway to consume those large deals and convert those to revenue. And hence, there's no, I wouldn't say, concern on any short-term impact on revenue growth potential because of the Q4 TCV number. So pipeline is great. I think the conversion to pipeline, yes, it's been a little bit slower because of seasonality. Client budgets were a little bit uncertain. Now we are starting to see that pick up as well. Activity is actually very, very healthy in most of our units and in most of our markets as well from a geo perspective. So I think that's the way to think about. There are 2 or 3 nuances on the TCV front, as I just mentioned.